To start this lesson out, I'm just going to rehash a few things that you should have learned in the first two lessons. There were no videos for those lessons. You should have discovered the 7 broad internal accounting principles: establish responsibilities, maintain adequate records, ensure assets and bond key employees, separate record keeping from the custody of assets, divide responsibilities for related transactions, apply technological controls, and perform regular and independent reviews. These are important to ensure that we are reporting adequate information, we are protecting the assets, we have, it also helps us be efficient. We'll operate more efficiently and it helps us uphold our company policies. So, if you are familiar at all with some of the incidents that happened that made us strengthen internal controls, the fallout in the late 80s of Enron Corporation and WorldCom, and there were some accounting irregularities that happened in both of those instances, and the public accounting firms also were drawn into those scams because they were not adequately assessing the internal control structures. So internal controls are a very serious thing. They became more serious after those transactions. Must have been actually the late 90s, early 2000s. So let's talk a little bit more about them. So hopefully you got these right. They should have turned green when you got them right. So the first one talks about the record keeper having the ability to write and sign the checks. So that shouldn't happen. We should have one person writing the checks and one person signing the checks if that's possible. On the second one, we have the employee leaving with some cash. I'm not sure how there was 184,000 in cash laying around, but that employee found it and off they went. So how we can mitigate that damage is by insuring the assets and bonding our key employees, especially those who are dealing with a lot of cash. In item C, we had a $500 check missing from a cash register. Here we have to you have to establish responsibilities. So if any of you have worked at a grocery store, you know that you have to get your cash drawer at the beginning of your shift, and then you take your cash drawer to the manager on duty at the end of your shift, and they count your cash to make sure that it is all there. And if it's not, they'll be talking to you tomorrow, right? In number 2, let's take a look at that. We shouldn't have had any problems with that. Here, now we're starting to talk about cash and cash equivalents. And cash equivalents are just items that are almost cash. They would turn into cash very quickly. Examples are treasury bills, short-term certificates of deposit, etc. So here again, we have some more true or false. We're applying now those internal controls to our cash. A guideline for safeguarding cash is that all cash receipts be deposited monthly or yearly. Well, that's false. We should do it daily, right? A voucher system of control is a control system exclusively for cash receipts. No, that's for cash disbursements, for paying out. A guideline for safeguarding cash is to separate the duties of those who have custody of cash from those who keep cash records. Absolutely. And separation of duties eliminates the possibility of collusion to steal an asset and hide the theft from the records. It does reduce it, but it doesn't eliminate it. We still could have collusion among the 2 people who have the separation of duties, or 3 or 4 or 5, and we would still have theft. In the next exercise, you were to do a cash over and short example. So if we discovered that the cash was off, we collected too much, we collected too little. So the entries for those were as such, and hopefully they made sense to you when you got them right. And this one we were doing cash and cash equivalents in exercise 6-5. And here you should have just added the cash in the checking account. We wouldn't do this. That's a long-term investment, 20 years. The treasury bill due in 1 month would be a cash equivalent. The 3-year loan to the employee, no. Currency and coins, yes. Accounts receivable, no. That's not cash. So we should have added the 3,000, the 5,000, and the 1,000 to get a total of 9,000. Here we were determining whether this indicates a strength or a weakness of the internal control. So if the sales clerk made an error recording a cash sale, and then she is allowed to correct it in the electronic record, no, that's a weakness because the sales clerk then has access. She's the one taking in the information and she would have access to make changes to it. All sales transactions, even those for less than $1, are recorded on a cash register. That's very strong. 2 employees are tasked with opening mail that contains cash receipts. Very strong. One of 2 employees tasked with opening mail is also the record keeper for the business. That's not good because that person then is responsible for making the deposit, opening the mail, having access to that check, and making the deposit. However, it is mitigated somewhat because there's another employee there. The supervisor has access to both cash and accounting records. Yes, that's a weakness. The receipts are given to customers only for sales that are above $20. That's a weakness because anything under $20 then is susceptible to theft. All right, let's now take a look at exercise 6-8. Most companies keep a certain amount of cash on hand to handle daily small incidental expenditures that they need to pay with cash. Example, run to the post office to get postage stamps. We may have cash on hand for that. This has probably been reduced somewhat by allowing employees to have debit cards and the ease of using the debit card at other places, but we still do have most companies using cash. We also would use cash sometimes for if we have some transportation that's come in and we have to pay for that transportation. It's $200-300. We might pay the provider of the transportation cash for that. Let's take a look at how we set up this. It's called petty cash, our fund of cash that we have available at our business. Usually needs to be in a secure location, a safe or something with limited access. And we call this a petty cash fund. If we look at exercise 6-8, we're going to walk through the steps that we will use for accounting for that petty cash fund. We've got Wapika Company establishing a $350 petty cash fund on September 9th. So let's take a look at that first. September 9th, we're establishing the fund. So what are we going to do? It's for $350. All right, so you should have a drop down here, and we do. And we're going to debit this account called petty cash, and we'll debit it for the amount of the fund. The first time that we're setting up the fund, this is what we do, okay? That's a very important distinction. The first time we're setting up the fund, or when we increase the fund, we'll debit petty cash. We probably won't again unless we have some kind of sale or something going through there, okay? Petty cash, and we're going to credit cash, like our checking account. So we wrote a check to establish the petty cash fund. On September 30th, we went through, we counted up the cash to see how much cash we had, and we looked at all of the vouchers or slips that we had for our expenditures, and we can see that we had $104 in cash remaining, and we had receipts for $40 for postage or for transportation. For postage, we had $123, and miscellaneous, we had $80. So when we counted it up, we found that we were short $3 for the fund. So 350 minus 40 is 310, minus 100 is 210, 190, 187. So we actually came up with we should have $107 in cash, and we only have 104. So that's how you kind of determine the shortage. So what do we do with all of this? Well, first we record the expenses. So the first one we had $40 for transportation in. We're going to debit that for merchandise inventory because remember that's a cost of our inventory. So if it was for a sale, it would be a delivery expense, but when it's transportation in, we add it to the inventory. Next, we have postage expenses for 123. And then we have miscellaneous expenses for 80. And then what we're going to do with that cash over and short because we're short, it's like it's an expense, right? We can't account for $3 that is somehow gone. So we're going to take that to our cash over in short account. We'll call that $3. Now, what are we going to credit here? So what we're going to credit, we don't credit petty cash, we credit cash again. Because what we're going to do is we're going to write out a check for the sum of all of these expenses and the shortage. So we're going to write out a check for $246. And what that does is that takes the balance back up to that $350 that we like to keep. So at the end of every month, we're going to count up the cash, look at all the vouchers, the receipts that are in our petty cash drawer. We're going to add those up, record them, and then we'll write a check to take the balance of the petty cash back to what we want it to be. So we credit cash for the 246. On October 1st, what happens? On October 1st, they decide they want to increase the fund to $400. So now remember what I said, the only times that we're going to be debiting petty cash are when we establish the fund or when we increase the fund. So here we are going to increase the fund by $50. Now we still have $350 because I haven't taken it out of this petty cash account, right? I did everything through cash. So I established the fund with a check, I replenished the fund with a check. Now I'm going to add to the fund with a check as well. So petty cash will be debited for $50 and we will credit the cash account, $50. Now, if you had had a cash overage, you would have credited that, right, and reduced the amount that you reimbursed here with the credit. So if this had been $3 over here, then this would have been $243, just so that you remember that that's how that works. If it's an overage, it's a credit. I think that was $246, right? All right, very good. Hopefully you are making your way through this module. It's a little bit shorter than the previous one, so a little bit of a break. And next module will be the last, and we'll work through a problem together.